Hello, this is Jordan. This video is being recorded on the late afternoon of Thursday, March 9th, 2022. Thank you so much for joining me today. And in this video, I am going to analyze the stock market, what looks to be happening right now, and what could be driving it, and where the downside potential is. So we're seeing a lot of weakness in the financial sector, especially from the banks and the regional banks. And so this is a weekly candle chart. We have the financials at the top, banks in the middle, regional banks at the bottom. And as they say, you can't have a bull market or an uptrend without the banks. And as we see here, the banking sector specifically is on the cusp of making a new bear market low. So that's obviously negative for the market. I mean, financials have been holding up better, but you do have the potential for a nasty candle there this week. I mean, we'll see how the rest of the week closes, but there's only one more day. And even if we do get a rally tomorrow, that's still a negative weekly candle, in my opinion. So, I mean, fundamentally, it makes sense. The financials, the banking sector, it's the heart of the economy. They need to be able to make money, to lend money, and you have this inverted yield curve, which is a real problem for the banks. It's not necessarily higher rates because sometimes the banks can benefit, but when you have an inverted yield curve this significantly, that's a negative for financials. So this really bears watching with respect to how much the financials will decline there at the top. But if we're looking at the banks, that looks bad. Those two charts, nasty weekly candles, potential for, I would say strong potential or even a likelihood of lower lows, new bear market lows in the banks. And so that's not good. And, we know from 2007, 2008, that can bleed into other parts of the market and the economy. So that'll be something to watch. And look, it doesn't have to be on the scale of 2007, 2008 for it to create problems for the economy in the broader markets. So that's a big driver. Another thing we should look at here is the potential for, so bond yields have been moving higher. Inflation expectations have been moving higher in the last month or so. The Fed higher for longer. We've been talking about it. But I think the markets are not quite entirely with the Fed in that case. And so we'll have to watch the 2-year yield, which again, the Fed follows the 2-year yield. It did get up above 5%, had a big decline today down to 4.9%. And, looking at these charts here, I think there's potential over the coming weeks for this higher for longer narrative. I mean, that can really get washed away quickly, especially if we see the 2-year yield. If we see this decline, I mean, if it starts to really come down more, I mean, we were above 5% down to 4.9 today. If we see that come down to 450 or even below that, you do have the setup. Then the 2-year yield, it made a higher high. You can see there, but the other yields did not. So you can see the 5-year yield did not, the 10-year yield didn't, and obviously the 30-year did not. We didn't show that chart, but so that's a non-confirmation with respect to these bond yields, and so. I mean, that's something to keep an eye on. But also, if you look at, the inflation expectations ETF, RINF, it's a good ETF for that. It is titled Inflation Expectations. And look, it has some commodities in there. It probably has some equities and, a lot of, tips and that sort of thing. So it is a good ETF for inflation expectations. Yes, break-evens are in there, and those have been moving higher. However, if you look at RINF, there's a potential neckline there right around 30. So what happens if RINF declines and it goes below that blue line? Same thing at the top there with commodities. GCC, that's an equal weighted commodity index. So what happens if we see these markets go below those blue lines, and then you have bond yields coming down? And so the point is, given what we're seeing starting to happen in the banking sector, the Fed with these aggressive hikes, they're going to go above 5%. And look, I did say this a couple of months ago that February could be the last hike. So I'm not trying to take a victory lap when I say this, but what if they hike 50 basis points this time, and then maybe the next meeting they go to 25, and then they're done. So look, the Fed follows the markets, and yes, I mean the moves in markets in February have given the Fed some cover to do tighter for longer, or higher for longer, excuse me. But again, if we're following these markets, there, especially commodities and inflation expectations, and also the again the financials, the banks here as a whole, if there is more damage in these places over the coming weeks, then the Fed expectation, the higher for longer, is going to evaporate really quickly. So that's why we have to key on these things. And of course, the stock market, which impacts our beloved precious metals, and so the thick moving average there, that line, that's the equivalent of the 40-month, which again, I've talked about the 40-month moving average. If the market loses that significantly, you have confirmation of being in a new secular bear market. If you don't know what I'm talking about, you have to watch some of my past videos where you look at the history, secular bull markets, 95% of the time, the market holds above the 40-month moving average in a secular bull. So S&P loses that significantly, and we can see here it's basically at 3,900. So there's not a lot of room for the S&P right now. And again, if the bear market isn't over and the S&P is going to drop down to 3,500 or even make a new low, it's strong. I mean, you can make a very strong case that it's a new secular bear. And then at the bottom, I mean, let's look at gold against the S&P 500. So yes, this is just the weekly line chart, but if we see the S&P, if this is the start of a more significant decline over the next couple weeks or the next couple months, we're probably going to see gold against the S&P rally up to that 0.5 level, that 2022 peak, and perhaps make a higher high. So that would be really bullish for precious metals. So keeping an eye on the stock market. And then, let's look at the resistance. I mean, 4,100 is significant resistance. 4,200 is very significant resistance. So you do have a nasty reversal candle here right now. And look, if the S&P cannot trade above 41 or 4,200, then, odds are it's going to obviously trend lower over the weeks and months to come. And so I'm not making a prediction here with my annotations, but that's just that's a potential for what could be coming over the next couple months. And just last thing I want to point out, if you look at the last 20 or 25 years, and you look at, if you look at the declines in 2000 to 2002, 2007 to 2009, and then even 2010, and some other the cyclical small declines that we've had, a lot of times the market peaks in March or May. I've noticed that. Like a lot of the cyclical declines started in March or May. So, we just started March. So that this is another, as far as the calendar and seasonals, when the market declines, again, the peaks from where the declines start, they tend to be in March or May. So we're getting into the seasonal time when the market is ripe for, not even, it's just ripe for poor performance and declines. Okay, so last slide here. This is my, mega bear market template, which, in the last month I kind of said we veered off a little bit from that. But if we look at the timing, we still are in the window here where we could get that accelerated decline. It doesn't, necessarily mean it's going to be a crash. I mean, it's great to use that in my title for the algorithm. But, that aside, the template, we're at the point where, this is the point in these bear markets where you tend to get an accelerated decline. And so if we look at the timing and we look at the percentage off the highs, we can measure it from, last month, the peak in January, or we can measure it from the current peak, as far as when this accelerated decline could start. Now, I think the market's in a little bit stronger position compared to those past examples there, because the market went it went above the 200-day moving average a couple times, so that it's in a stronger position, and it hasn't completely fallen below the 40-month moving average, which in those other cases, I think in most of them, it already did so by that point. But nevertheless, if we're looking at this template, I mean, we are at the window where we do have to be mindful of the start of an accelerated decline. And so that's all for this video. We haven't done one of these in the last month or two because the market's been rallying, but now we have to pay attention. And look, obviously, with respect to precious metals, if the market loses the 40-month moving average, it trends down, it sells off. I don't care if the miners sell off, because in that scenario, the gold S&P ratio is going to go up. It's going to make a higher high. You're going to have a signal that a new secular bear market is likely starting, recession coming, so rate cuts. That's, like I talked about in the last video, that could set you up for the double bottom in the next couple months, where you have a really powerful double bottom. And then when the market starts to discount rate cuts, or at least the end of tightening 1,000%, that's going to be enough for a really, really oversold sector to start rallying. So I'm just thinking off the top of my head, but we have to monitor the setup, because if the stock market continues to decline, loses the 40-month, it's all going to be really good for precious metals. So we'll definitely continue to monitor that for you. Thanks so much for tuning in. Let me know what you think in the comments, and I'll talk to you guys again in the next video.